Welcome back, everyone. Sniping the high of the day in NASDAQ, riding it down into the sell side, making 2 times what 2 losers yesterday set me back. And that's the importance of good money management. Shorted the high of the day, over $1,800 made in less than 5 minutes. One of the other things I want to take to your attention is I shared my 2 losing trades yesterday. As always, I share everything. But I want you to notice 2 losing transactions yesterday were easily fixed with 1 trade today. That actually made me double what I was set back yesterday. That is the importance of good money management. One of the ways that I was able to stay cool under pressure, stay poised, is because of my journaling. I know every single day, every single week, there's easy setups that easily allow me to recoup my losers and are going to put me well in the green. You only get to that point, you only acquire that confidence through journaling, back testing, and knowing that you know. You're going to watch the full trade live from beginning to end with me, as well as a short market review as to why I took that trade and the model I was using. Hope it's insightful. So looking at the hourly chart here, very interesting. We're seeing a bit of a heavily decoupled, or a heavy decoupling rather, between these two markets. We see NASDAQ way up above its previous all-time high here, and S&P not even close to that previous day's high here. So we're seeing a huge divergence there. Now, I'm not saying that's a S&P we're going to sell off and I'm calling a top in the market. Like, I'm not saying that at all. I'm just saying it's suspect that the NASDAQ is rallying so heavily and the S&P wants no part of it and the Dow wants no part of it at all. That's very suspect because if you look at the Dow here, it's weak, it's bearish in its market structure, and NASDAQ is bullish. So we have decoupled markets on the higher time frame as well. So do keep that in mind. And what does that mean? That's decoupled markets on the higher time frame. Like, what does that start to indicate to me? It could indicate a shift is coming, right? For example, yesterday, how did I know that that pump higher on NASDAQ, that was suspect, and then to go short and look for that run to the downside? It was because the Dow and the S&P were dropping while the NASDAQ was going higher. So that was telling me that NASDAQ is running higher as like a suspect rally, and then it's going to look to drop and catch up with them. So that's how you can use decoupled markets. It's giving you an indication as to things are likely to reverse and shift soon. So I'm watching that. That's important to me right now. So I would use this as the first presented gap here. So we see the market open, drop down into it, respecting the upper half. That's bullish. And it draws this line here. All right, if we get underneath this first fair value gap here, my attention is going to go to this opening range gap. Have your quadrants on here. What I mean by that, for those of you guys that are new, you want to have every day, you want to have a template with this, a template with your opening range gaps. It should look like this, and then you have the quadrants on that. So that's something you always want to be mindful of. If we get below first pres here, then I'm going to look for a run into the opening range gap high and then upper quadrant initially. And then I'll see how we trade there to determine if we're going to get a repricing down to mid gap. All right, so S&P dropping. The level I like for ES right now, I'm going to go to the 15-minute chart, show you. Sell side down here. These of those here are relatively equal. We saw S&T with ES and NASDAQ. ES not even get close to this high. It's breaking down. As long as you respect the order block here, the 2 up close candles on the 15-minute chart, I'm looking for repricing to the sell side down here. So I'm watching this fair value gap here, see if that wants to be a sell-off point. So watching this city here, this fair value gap, and then watching this gap here on NAS, see if we can respect the lower half. I'm going to go and take a short here on NASDAQ. Tight risk on this one. Stop's just going to go above the first fair value gap here. And see if we can get a flush. All right, watching this up close candle here. I want to see us act as a bearish order block. And then if we're going to remain bearish, I want to see us stay below this first fair value gap here. Yeah, like how this gap here left open, stayed in lower half of that first presented gap. That's bearish. I'm going to go ahead and trim risk now. I like how on the 15-minute chart we created a wick here. This candle open traded higher, couldn't get to 50% of the wick. That's telling me we're heavy right now. So I want to see the market stay bearish here. All right, stop goes to cover costs here because we got so close to my target. Stop goes to cover costs. All right, on this other account, it's flirting with that low a little too much. Yeah, we're closed out. Bang. All right, let me do a short review here, and then I should be able to do a short review, watch the news with you guys, and then I'm gonna get out of here. And I'll take your guys' questions. If you guys are still holding runners, consequent encroachment is the next draw here. Let me show you guys that here real quick. So I just took profit at the upper quadrant, like I was telling you guys, right? So I took profit off here, the upper quadrant, but consequent encroachment is the next draw. So I look at this pump here at 9:30, like they're suckering in everybody long, getting people to feel FOMO, like, oh man, I can't trade it anymore. Yeah, it's going off without me. Oh. But this is all suckering in retail long, right? Because they think they're gonna miss what the next run. They're gonna miss the next run higher. So they give the retail the bait here, pumping it higher. And then my exact words were, we're gonna watch first pres. And then if you guys know about gap theory, if you've gone through that concept, or if you haven't yet, you're gonna get there. No worries. But gap theory would suggest that if we get below the fair value gap and then we respect the lower half, that's telling you the market's really bearish, right? So this is a model in and of itself. I'm going to teach you all my models in the mentorship content on WAP. Hope all you guys are enjoying that. And you guys are going to learn all these models. This is one of them, and I'll share it with you guys here. One of the models that I use with an inversion fair value gap, which is what this is. So this is how I trade inversion fair value gaps. I don't chase it and then have a 80-point stop loss. So the way I trade inversion fair value gaps is I'll wait for it to close below it, right? And then what I'll wait for it to do is trade back up into it. And then once I see it respect the lower half, right, and prove that it can't get up into the upper part of the gap, I will short the next fair value gap on the lower time frame once we displace away from it. So let's start over again. Inversion fair value gap, once we get a closure below it, I want to see the market respect the lower half. That's proving algorithmically it's bearish, it's weak, it's heavy. When I see that, that's telling me we're weak, but it's not just telling me it's bearish. It's not just giving me direction, it's giving me timing. Why do you guys think most of my trades are like this? Entry, no drawdown. It's because I'm entering when specific signatures are present in the market, right? It's like Neo in the Matrix. When he learned to read the Matrix, it's just code. You can see it for what it is. Well, that's basically what the markets are. You got to learn how to read the code. Read what the fuck the candles are telling you. Very, very important, guys. So looking at the 15-second chart here, once I saw the market respect it, and then we saw that next displacement away, I took a 5-second entry. So I'm still shorting when the market's going up, right? So we have a fair value gap here. Wow, 5-second chart, Dylan. How do you use that? It's the context of the market top down, right? So 5-second charts are great if you know what you're doing. So if I know the 1-minute chart is going to drop like a rock, then I can use a 5-second chart to get in sync with that motion, get in sync with that move that's already in motion. So we see the market close below it, trade up into that fair value gap, respect the lower half. And then as soon as we get the next displacement away from that gap, short the next fair value gap. I was going to wait for a 15-second gap. Normally I do, but it didn't give one, and I wanted to get on this run. So I wanted to use the 5-second chart just to make sure I got an entry. So 5-second chart here. And then the stop can go above the gap that you used as an inversion. So that's the full model. I'll break it down in great detail. That's one of my most high-powered models, but I got a lot more to share with you guys. But the stop placement goes above the gap that you were using, right? So for example, I'm shorting in here. So where'd my stop placement go? Right above that gap that I was using as an inversion. You see that? And then if you look at the risk reward on my trades, nothing astronomical, but I'm risking about 15 points to make about 45. Wait, make sure that's right. Yeah, to make about 45. So one of the things I want you guys to study is look at the size of my losing days and my winning days. For those of you guys who have been here for a month, you saw 2 losing days and you've seen a shitload of winning days. Notice the size between the winners and the losers. And over time, I know right now maybe holding for a 45-point trade, 60-point trade might be a lot, but over time that's going to get really easy for you if you're doing the things I'm telling you guys to do. If you're doing the work, if you're doing the legwork on your end, you will absolutely be able to do this beyond a shred of a doubt. Don't get discouraged by what I'm saying now. I always feel the need to say this because I don't want you guys to think like I'm shitting on someone that's starting and doing 1-to-1, 1-to-2, like I'm telling you guys to do, right? It's a great idea to get in, start with low-hanging fruit, maybe get in here and get paid here at the low, or get paid here after you get 20 points. That's fine because you're developing. That's where I started. Over time, though, and this will all be taught in money management, especially when I get into month 5 and 6. Eventually, when you get good at this, you only want to take trades that offer you a decent risk reward. So if I can't get a good risk reward, I'm not going to trade it, right? So that's the professional mindset. The retail mindset is I'm just going to chase every single candle around and hope something happens for me. Whereas professionals are considering, okay, I want low risk, high reward opportunities. Because if you're going to use your risk, you want to use it for something that's going to give you an opportunity to take something from the market. So does it make sense to open up a 30 handle stop loss to make 15 points? Probably not, right? But if you really look at some of your trades, many of you guys might be doing that. So use this to understand, okay, when am I using my risk? Am I just opening up risk all the time, or am I using it for specific trades that are going to yield me a reward that's worth the risk I'm incurring? As traders, we have one tool. It's how we use our risk. So you need to learn how to use your risk well and not just open up risk all the time. Open up risk when there's a reward to be made that's worth it for you. And then over time, the next level of development for a lot of you guys is going to be, well, I'm not trading any 1-to-1, 1-to-2. I'm just going to wait for 1-to-3s, 1-to-4s, 1-to-5s and trade that. And that's exactly what over time you guys are going to be able to do. And now when you're trading with 1-to-3 multiples, 1-to-4, 1-to-5, how many losing trades can you have and still be profitable if you learn to read the charts like I'm showing you guys here? Lots of them, lots of them. So that's why it's not about avoiding losing. You just have to avoid going on tilt. That's the only thing. You don't have to avoid losing. You just have to avoid going on tilt, losing control of yourself. If you can fix those things, apply good money management, learn to read price action, you guys are going to be some killers.